Why would a massive global steel company sell its own soccer team for just $1? Is this a bargain deal, or does it signal total failure? The headline sounds absurd until you understand the hidden rule of finance: strategic fit always beats liquidation value. Today we connect that shocking price tag to how your household decisions work when assets go from profitable tools to financial anchors. This distinction tells you whether a cheap asset is a golden opportunity or a trap waiting to happen. In standard valuation, people often look at the sum of parts, known as liquidation value. They add up trophies, stadium rights, and player contracts to guess what an item costs if sold piece by piece. However, market price is driven entirely by future cash flow potential. When a parent company no longer needs an asset for its core strategy, they may sell it below the cost of those physical assets just to stop bleeding money or cut operational losses. For Tata Steel, this soccer club was not generating enough revenue to justify keeping it on their books while distracting from their primary steel business operations. The sale price reveals a decoupling between brand equity and financial reality. A soccer club's value is often found in its fan base and regional loyalty rather than just the physical stadium or equipment. For Tata Steel, this specific brand asset was not generating enough cash flow to justify the operational costs required to maintain it as part of an industrial conglomerate. The $1 price tag reflects that for them specifically, the asset had negative strategic value because they could no longer extract profit from their core competencies in steel manufacturing while managing a sports franchise. This highlights why value is relative to the owner's strategy and not just what sits on a balance sheet. A new buyer likely sees future cash flow potential where Tata saw none at all. They may be a specialized sports entity looking to monetize fan engagement directly, or an organization seeking tax benefits and government subsidies for regional development common in Indian sports leagues today. The massive difference between the $1 sale price and what experts might estimate as market value proves that assets change worth based on who holds them and how they fit into their specific business model. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. You must learn to avoid falling into a value trap when you see headlines about cheap sales. Viewers often assume a house or business sold for pennies is an undervalued gem, but this case study teaches us to ask if the seller was desperate due to hidden debt or missing strategic reasons. If you do not have the specific strategic fit that made it profitable before, buying at face value might mean inheriting their problems rather than finding a bargain. You are essentially stepping into shoes designed for someone else's business plan, which may no longer work in your hands. Consider how this applies to life milestones and personal finance decisions like selling a family home or closing an old side hustle. Sometimes holding on to something because you built it is the wrong move if it costs more in maintenance time and money than it returns in value. Knowing when to cut losses by accepting a low price versus waiting for market appreciation is critical financial literacy that separates successful investors from those who hold deadweight assets too long. The difference between a bargain and a trap often comes down to strategic fit, which means what works for one company's strategy might be a severe financial drain for another entity entirely. A farmer might sell their tractor for $1 to a mechanic needing parts, but that same tractor is worth thousands to another farmer who needs it for harvest season. The asset itself did not change, only the user and their specific need changed. This principle explains why Tata Steel walked away from a valuable brand, while a new buyer sees infinite potential in the exact same assets. When you see an asset selling below its liquidation value, ask not if it is cheap, but why the seller would rather pay someone to take it than keep it on their books anymore. In finance, an asset's true worth isn't what it costs to build, it is how much cash flow it can generate for its specific owner right now and in the future. A $1 sale does not mean the brand was worthless globally. It simply means the current owner no longer needed that specific piece of their puzzle to succeed in their core market. This framework helps you evaluate investments by shifting focus from physical assets to cash flow generation potential. Investors buy cash flows, not just physical objects or nostalgic memories attached to a building. If a business model does not work for your specific goals and resources, its market price will drop until someone who needs that specific piece can make it profitable again through their unique strategy. This is why understanding the seller's motivation is more important than looking at the sticker price on any transaction you encounter. The Tata Steel case serves as a powerful reminder that financial logic often contradicts emotional attachment or surface-level appearances. A company will always prioritize its core competency and long-term survival over maintaining assets that no longer serve their primary mission, even if those assets look valuable to outsiders. This discipline allows them to redirect capital toward opportunities with higher returns rather than sinking funds into projects that drain resources without providing a return on investment for the parent organization. By understanding these dynamics, you gain clarity on how markets actually price risk and opportunity versus what headlines suggest at first glance. You learn to look past the shock of a low sale price and investigate the underlying strategic reasons driving such transactions in corporate finance. This skill transforms how you view every financial decision, from buying a home to evaluating business opportunities, or even managing your personal savings strategy for long-term growth without falling for deceptive value traps. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.